Hello, everyone. Thank you for coming to another week with Live with Caeli Ridge. As a reminder, we have these meetings every Tuesday, starting at 4:30 p.m. Eastern, 1:30 p.m. Pacific. And thanks to the gloriousness of Ridge Lending Group, we get this hosted and we cover a whole bunch of topics every week. Today's topic, we're going to focus in on when does it make sense to refinance. Usually that includes something that covers goals, costs, terms, and we're going to turn to the all-seeing, all-knowing Caeli Ridge, and she's going to tell us exactly down to the second when we should refinance.
Down to the penny.
Down to the penny.
The second and the penny.
Thank you, Caeli. All yours.
Hey, you guys. Thanks for being here with me today. Thank you, Larry. It looks like we've got a nice, small, intimate group. I love that. So hopefully we'll have plenty of opportunity for Q&A. If you guys have any questions, feel free to just type those into your chat, and Larry will let me know, and we can do some deep dives on this or whatever you guys want, really. So yeah, refinancing is what the topic of the day is. And any of you that have been in here on a weekly basis or even come in once before to these live events, they're pretty casual, unscripted. I'm just going to kind of talk about what I have from my finger on the pulse as it relates to what the topic at hand is. So let's get into it. When is it a good time to refinance? So ultimately, it's going to depend on the individual circumstances of the property, right? The things that you're going to want to be looking for are, what is the purpose of refinancing? First of all, is it to harvest equity, right? And meaning harvest equity, that means that are we trying to do a cash out refinance to grab at some of those equity dollars and do what with them? Is it to harvest equity and then redeploy it for more real estate investing? Okay, or is it that we want to take an existing loan and replace it with a new loan, which is called a rate and term refinance? And in which case the optimal requirements for wanting to do it that way, let's focus on that because it's a little bit easier to define. A rate and term refinance is really only going to be about bettering your current or improving your current mortgage. So is the interest rate X versus what the interest rates that you can get today being Y? Is your current loan on an adjustable rate mortgage and you want to get it into a fixed rate mortgage? Is there a balloon feature on that mortgage that's coming up that you have to be prepared for? So those are some of the things that you want to account for when you're deciding if just to refinance to replace the current terms makes sense. There needs to be what we call in our industry a net tangible benefit. Generally speaking, if we're just kind of stay on the path of rate and term refinance, the net tangible benefit, we want to see that the cost of the refinance is made up with the savings, usually within, 36 months, sometimes 60 months. Now that leads into another component and a question that you have to ask yourself is how long are you going to have this property? Do you know that you're going to probably sell it in a couple of years? In which case, then when we do the math of cost versus savings, very simple mathematical equation, you take the cost of the refinance and divide it by the monthly savings that you're going to get of this refinance, and that's going to produce the number of months. So when you have that, you can solve for, does this make sense based on how long you think you're going to have the property? Keeping in mind, when you're doing that division, the cost of the refinance, don't confuse that with the taxes and insurance. Now, while the taxes and insurance are going to be collected up front, those aren't necessarily what I would consider a one-time cost and what should be in that formula. Taxes and insurance ultimately become an asset to you because if you've got your property impounded, which means your taxes and insurance are paid with your principal and interest payment. So when you send out your monthly mortgage payment, it includes your principal, your interest, your taxes and insurance. Those taxes and insurance a lot of times are front-loaded. We're going to collect a certain number of months. On insurance, we want to show a full 12 years of the property being insured, plus maybe 1 to 3 months of reserves in extra. The reason we do that is to protect our interest in the event of default, to make sure that, if we have to foreclose, there's extra insurance coverage on the property so that while we're going through that process and maybe getting the property ready to resell, right? That's from a lending perspective. Similarly with the taxes, we're going to collect taxes from, if it's, on a refinance, from that date to the end of the tax year that hasn't been collected yet, we're going to collect that amount and we're going to hang on to it. So both of those amounts are going to be collected on the front end. And then once we close on that loan, every month that you're making your mortgage payment, 1/12 of each of those amounts is being collected. So those amounts typically are going to be what goes back out the door when the servicer goes to pay your insurance agent or goes to pay the county for the property taxes. So the reason I go into all of this is that when you're using that math to do the division on the cost-effective analysis, right? If you're going to decide if it's going to take you 24 months to recapture the cost versus the savings, the taxes and insurance shouldn't be included as part of those costs. So I just defined how we're going to collect, but what will happen is that when you go to sell or refinance this property later on down the line, those monies that were collected up front will come back to you. The escrow account that's been kind of sitting there and building up additional monies so that those amounts can be paid will be refunded. Now, it's not going to be dollar for dollar, but it's going to be close. So when you're doing that math on a rate and term refinance, just make sure that you separate the taxes and insurance, or what they call the impounds, what's going to be collected, from the actual one-time closing costs, those upfront closing costs. So monthly savings and the closing cost is the division that you want to figure out how many months it takes you to recapture the cost versus the savings. Keeping in mind that that cost, while tangible, more often than not, it's not going to be something you're coming out of pocket with. It's going to be rolled into the loan. Okay, so it's not going to be a realized out of pocket expense. It will be financed in. So anyway, that's what I would say in terms of a rate and term refinance. Closing costs, take out the taxes and insurance, just look at the one-time closing costs, divide it by the monthly savings. And if within that division, the number of months, that's what it's going to produce, is 12, 24, 36, even 50 months, it's probably making sense to me to look further into refinancing that property if you know that you're going to have the property for at least that long or longer. Any comments, questions about that?
So there's no questions yet for those folks that are just arriving. Caeli's going over when does it make sense to refinance, going over options, ideas, comments on costs like you just heard, and considerations for when you should refinance. No questions yet, Caeli, but one of the things that I did want to ask on this rate and term refinance, do you feel that there might have been some folks who try to refinance their existing debt to make payments more affordable because of something coming up into the future? Have you ever seen that happen where maybe they're on a, they've had a, let's just say for sake of argument, like a 30-year loan, they've had it for maybe 5 or 10 years and they need to just get that payment lower. Even now when interest rates are a little bit higher than they were 12 months ago, it still makes sense to get that lower payment because of something coming up in the future that they're trying to plan for.
Absolutely. But so let's go through that a little bit further with me, Larry. Under what circumstances would we be able to lower that payment if we're taking from a 30 to a 30 and the interest rate is higher, right? We're not rolling in any other expenses because that would then be a cash out refinance, right? So
yeah, so let's say for sake of argument, you had a $200,000 loan 10 years ago, and now you're looking at, again, a 30-year loan over the remaining balance. And the one thing that I see coming up, where I see some folks worrying about, is things that are coming up, like maybe college tuition they need to figure out into their budget, into something that might be happening in a few years, not necessarily today.
Yeah, so good point. So just to kind of recap what Larry's saying there is that, yeah, even if your interest rate that you have today is lower than what the prevailing interest rate is now, right? What you would lock into, if you're paying 4% here and rates are 5% now to refinance, if you're refinancing that mortgage or rate and term refinance at a much lower loan balance, right? You've already paid it down quite a bit just because you want to reduce that monthly principal and interest payment for reasons like kids are going to college and you want to make sure that your monthly expenses are really tightened up, nailed down. Yeah, that certainly makes sense. And in terms of interest rate is such a hot button topic for everybody. And I'm constantly trying to discourage people from getting too emotionally attached to an interest rate. I'll repeat this, you guys, if you've heard me talk about it, you've heard me say this before, I'm not at all insinuating that interest rate isn't important. I'm just saying that the math is what's important, right? You want to just make sure to do the math, and the math will not lie. It will be the truest identifier of whether it makes sense. All right, so rate and term refinance for any of those variables that might make sense to do so. Let's focus more on the cash out refinance because that's generally what we see more often than not. Unless, like I said, you've got some high interest rate bridge loan that you're trying to get out of, you've got a balloon payment, you've got an ARM, or some of the other reasons that we identified. On the cash out basis, here's what I want to look for. I started the recording by saying we want to identify how much equity do we have to harvest. What are we going to do with that equity once we have it? Are we going to go on vacation with it, which may be okay. We'll get back to that. Are we going to buy a new boat? Are we going to redeploy it for more investment properties? Don't get too hung up on that rate again. Chances are, if anybody's refinancing right now, unless they completely missed the last 24 months of interest rates, they're going to be locking in higher rates than what they had. But if they have the available equity and to pull out enough that makes sense to redeploy, I'm just going to assume that everybody on this call, if they're considering a cash out refinance on an investment property or even on their primary residence, it's for the purpose of taking it and sending it back out for real estate investing. If that isn't the case, we can certainly have those discussions, but my going forward commentary is going to assume that that's really what we're talking about. So first we got to figure out what is our baseline value? What do we think the estimated value is going to be? Where are you getting that information? You probably want to be looking in a multitude of places. And if you have anybody local to where the property is occupied, that is your property management perhaps, or a real estate agent, make sure that you're getting data from them. As much data as you can get about baselining that value, the better. There used to be days when I would say, this has probably been a few years ago now, Zillow is the last place on the planet that I would go to try and baseline an estimated value. That isn't the case anymore. Whatever Zillow did with their algorithms, I'll tell you, they've come up a lot quicker and better in predicting or estimating what those values are going to be. So Zillow, Redfin, we internally have access to some additional reporting modules. We have a valuation module that we use. We have access to county records that we can pull recent sales, like-kind properties. So certainly leverage our information if you're trying to get an idea of where that value is going to be. At the end of the day, keep in mind that the appraisal is the end all be all. And appraisers are not created equal like anything else. And, it's an opinion of value in large part. So just make sure you have enough data and that you feel confident or comfortable that whatever that appraised value is going to be, that it's within a small variant for error of what you expect. So once you've determined that, then we're going to figure out obviously what you owe on the property, what's the balance. And then finally, we're going to figure out what the loan to value restrictions are. What's the maximum that we can leverage against, and then work it backwards and figure out how much equity that you'll have to harvest and then redeploy. Remember too, another kind of cool thing about refinancing, especially on investment properties, well, on any property, but borrowed funds are non-taxable. So if you're going to grab at this cash to redeploy, there's no taxable event that's going on there. So now getting down to when it really is going to make sense is the math again. We have to trust the math. So figure out what your current principal and interest payment is. Okay, don't worry about the taxes and insurance. Those are static. They're going to be what they're going to be regardless, right? You also want to kind of put in the background there, what are the rents? What are the current rents on this property? So current principal and interest, what's the new principal and interest of taking out this cash? And what am I going to get in return? I've got this cash, I'm going to deploy it. What is the rate of return that I'm going to get as a result? And does it make up, right? If it's going to cost me an extra $200, my payment's going to go up an extra $200 over here when I do this refinance, but this cash is going to produce me $400. And you've got a new piece of real estate that you've got depreciation with and appreciation with, and right. So that makes sense to me, right? The math is going to be pretty simple in that case. So those are the numbers that I would start by looking at. If I take this a step forward, I'm going to say that the other piece is make sure you're identifying the properties in advance of getting the cash, please. Don't land with $100,000 or $50,000 of cash out refinance money that's going to sit immediately, and you're going to be paying interest on money that's not ready to be used. You really want to have a plan, right? Where is that money going to go? Have you identified the market? Have you identified the turnkey or the real estate agent that you're going to use? And if you've done all that, have you looked at the inventory? Do you know what the returns are? Yeah, so that would be important. And then going back a second ago to when I said, make sure that you've got in the background what the rents are. Ideally, and not everybody's going to subscribe to this philosophy, but ideally, as long as you keep the cash out refinance and the rents at a break even, at least, I would hesitate to tell someone to execute on a cash out refinance that's going to create a negative or a monthly loss. Unless what you're putting it into is going to be so secure and of such a great monthly value to more than cover this without a lot of risk, then maybe we have that conversation. Otherwise, I would say in terms of the property and its cash flow and its ability as it stands with the cash out refi, make sure at least it's covering it and not going over in the negative. Okay, let me take a pause. Anybody questions? Anybody got anything?
Yeah, I was just going to say it's a great moment to take a quick breath and just remind everybody, if you have any questions or scenarios or what ifs, two ways to get those to Caeli. First is to simply type it in the chat box, or if you feel like it, go ahead and take yourself off mute and ask again. Eddie did make a comment, Caeli, which I thought was great. Eddie's comment was, "This is so good that you're talking about the psychology effects of high rates versus the math on savings." And I can always think back to folks who are considering, doing something with their financing, and everybody gets so focused on the cost of the money. And like you just said, it's, well, what are you going to do with the money? How much is that going to really impact you? So there's
Yeah.
that.
Yeah. And remember the other thing, hi, Eddie. Hi. The other thing I would say with that on that tone is that if you decide, there's always, so we're talking about investing, and I said I was going to kind of focus on that, but what happens if we can take, and this is the historical reason to look at a cash out refinance for homeowners and investors alike, getting that equity and paying off consumer debt at a higher interest rate, right? That always makes sense. So if you're going to roll that into the equation, whether just to eliminate having to pay higher interest over here on X, Y, and Z, or for the ability to qualify for future purchases, perhaps, whether or not you're getting any cash back, but if it means that it'll help you qualify for the next, that would be another reason to consider a cash out refinance. There was something else I was going to tell you guys. Oh, I know what it was. I saw Axel's name. Axel Mehrhofer is a very valuable client of Ridge Lending. He is on this webinar, I believe, and he and I had a back and forth exchange recently about interest only. So since we're all here, I figured, just as a sidebar conversation, interest only as it relates to mortgage finance and more specifically investment property. So interest only is a unique strategy, and I actually approve. I like an interest only loan. We haven't been in a space within our rate market that we've been able to deliver that, even on a non-QM basis for our investors. Interest only just hasn't been available, and if it was, the interest rate is so high that it defeats the purpose of wanting the interest only. I mean, most investors want an interest only loan because it really helps with that cash flow, and it also allows you to accelerate payoff at your leisure. Right, an interest only payment, while I agree, is not plunking down on any of the principal, you control that, right? You can add any addition to the monthly interest only payment that you want if that's important to you. A lot of investors would argue, why would you do that? You've got somebody else making the payment. It's going to appreciate, obviously, if it's in the right market, et cetera. But interest only, more than anything, I think investors use it as a tool to really maximize on their cash flow. Now, as it relates to what's available in real time today, I'm seeing something pop up. I'll let you read that in a second, Larry. It's still kind of in the infancy. I'm really not seeing it in the mainstream yet, so it's not technically available. We do have some interest only products, but I would say that we want to do the math. Again, let's do the math and figure that out, because the rates are going to be significantly higher. So all we have to do there is we have to figure out the interest only payment at whatever that rate is against a 30-year fixed payment at whatever that rate is. And if there is a significant savings monthly, and that's your goal, is to maximize that cash flow, then the interest only would be available. We'll need to do the math, like I said. What was that question from?
So the comment was from Axel, and Axel's comment is it also plays on the correct, according to Axel, assumption that we can't afford these high interest rates for very long, and that he assumes we'll go back to low rates in the next 3 to 4 years. And interestingly enough, on this topic, there is, as a country, absolutely, Axel. There's talk of with a fair level of certainty of recession in the next year as the Federal Reserve continues to increase Federal Reserve rates, driving up longer term rates, slowing the economy down, and have a pretty big snapback to having decreased inflation. But who the heck knows? Caeli, do you have your crystal ball? Do you know how to do these things?
There's too many variables for me to try to predict, and so many of you that have spoken to me personally have probably heard me say that I've been wrong more times than I care to admit in predicting where interest rates are going to go. I'll tell you what I think, but please keep in mind that people a lot smarter than me get it wrong all the time. I think I would tend to agree with most of what Axel has shared. I think that over the next couple of years, we'll start to see interest rates come back down. By next couple of years, yeah, 2, maybe 3, maybe it ends up being longer, but yeah, the recession may push us over the edge based on what the Feds do in the coming months. But outside of all of that, you guys, there's so many other variables at play and at work that dictate how rates are going to move. It's really impossible to predict with any certainty or accuracy. I'll give you another for instance or example. So I've been around long enough to have seen several different cycles of mortgage rates and housing, et cetera. And historically speaking, when the stock markets sense extra volatility or uncertainty, we usually will see investors flee from that more volatile space of the stock market and run into the safe haven of mortgage-backed securities. Those are more secure. They're not going to pay as high a return, but that's what we usually see happen. When we see that happen, interest rates improve. Now, Ukraine and Russia, right? War is a number one indicator of what would create that kind of volatility. So I've been kind of hanging back and watching things and kind of trying to keep my eye on interest rates and how they're moving. I have not yet seen that any of that has produced investors' change of heart and running into the mortgage-backed security space. Some people, and I've asked this question, some people have said that the stock market thinks that this is going to be a short-lived war. And maybe that's true. But then on the other hand, I'm reading things that say, no, this isn't going to be ending anytime soon. So again, who knows? There's too many variables for me to try to predict.
And Axel, just again, speak for Axel. So if in the chat, Caeli just says, keep in mind that on the interest only specifically, that the interest only payments are going into a property that hopefully appreciates at the same rate as inflation. So ultimately, when you refi into a longer term mortgage, it becomes a trigger for further investments. I'm assuming you mean by the cash flow opportunity, Axel, because you're moving that debt to interest only instead of an amortizing payment.
I think he means because it's appreciating. So you're still going to owe what you started with, but the appreciation is going to make up the spread, right, Axel? Feel free to unmute if you feel like it.
Yes, exactly. That was exactly what I meant. Because, with the appreciation, let's say you have a $200,000 property in 3 years, 4 years of this kind of inflated or increased interest rate environment, even if we only have, let's say on average 6%, that's 25% more value when you refi that you have immediately in hand when you basically pay back the original loan, and you can keep investing and didn't put that money into principal and didn't lose anything on it. But the more important why I pointed it out is from my perspective, who really wants to pay 6, 7 or potentially more percent interest for no good reason if there are alternatives?
Sure, I agree with that. And the other thing too is that I just lost what I was going to say. Interest only, keeping it stays the same. On a 30-year fixed mortgage, guys, if you're going to be in that space where you're purchasing properties that are in a relatively strong appreciating market, right? And if we think that as inflation goes up, we think that the appreciation is going to kind of keep up with it. If you are going to use your investment properties in a way that I think is probably wise to harvest that equity, right? To continue to do cash out refinances in every 3-5 years, maybe even 6 years, a 30-year fixed mortgage, the first 10 years of that mortgage is 99% interest anyway. The amount of principal that you're going to actually plunk down in the first 5 years of a 30-year fixed mortgage is negligible. So that might be another reason or a strong case builder for the interest only. I hope to see it be more prevalent in my day-to-day and what we can offer and what we have access to. Again, we have it. It's just not where I would like to see it. Depending on the deal and the numbers, it may not quite make sense yet, but I feel like the tides are turning, and that's going to come online maybe in the next, it could be 30 days, it could be 6 months. I really don't know, gang.
And Axel, just make a final point here, just to, the reality is, how long do we keep our mortgages for?
Yeah. Yeah. What else? Anybody else have any questions?
Caeli, I would ask, in terms of, again, planning for future situations, if you were going to be moving and you, because you live in a property and you were going to turn that into an investment property, is there a prohibition about if you, with the occupancy? In other words, after a refinance, do you have to stay in your home for a certain period of time?
Yes, good question. So and we'll just stay in the conventional space, any set of conventional loan documents that you sign specifically for an owner occupied, the language will say that you intend to occupy that residence for at least 12 months. Now, I am not telling anybody, I'm not giving anyone advice necessarily, but the language says intent, and intent is the operative. There are things in life that come up, right? You just bought this home, and 3 months later, your mom is in the hospital and you've got to go move to Texas and care for her. It works out sometimes where that may not be the case, but the legal document that you're signing specifically says you intend to occupy that residence for the next 12 months. How do they know that you did or you didn't? I couldn't say. I don't know that they would, but it's a legal document and you're signing it.
Thank you, Caeli. Eddie, you had a question? Perhaps, maybe not. Saw a hand up, could have been wrong.
I do have a comment
Michelle, please go ahead.
about that. Hi, Caeli and Larry. So I remember some years back, I did a refi, and they actually did send someone out to our house to prove that we were indeed living in the property. And of course we were, but that had never happened to me before, but it did that one time. So I will say that although it, like I say, it was the one time out of maybe 10 times we refinanced that has happened before.
Yeah, I'm glad you brought that up, Michelle. So what she's talking about, you guys, is called mortgage maintenance. Now, I know that this used to be pretty common back in the day. I don't know. I wasn't aware that they still did it. How long ago was that, Michelle?
It was a while back. Yeah, it was, I would say maybe 7-8 years ago. Okay.
So mortgage maintenance means that, and I don't know if it's random or if there's a profile of a particular loan that gets highlighted or pulled. I'm not really sure what the background of this is. This means that they, in mortgage servicers and investors have field agents where they'll actually go to the property. And I've heard stories where they can be pretty sneaky. They'll check the mailbox, they'll look in there and see if the mail is addressed to the individual on the loan. Because the reason for this, the backup for this is that people were going and buying properties as a primary residence or refinancing as a primary residence because we know that interest rates for an owner occupied are going to be more favorable than for an investment. And the reason for that is that the risk mitigation, right? The investor that's lending you money believes that if you're going to default on something, you're far more likely to default on a investment property than you would ever default on the home that you live in. So it's layers of risk, right? So that's why the interest rates on an owner occupied, at least one of the reasons, are going to be more favorable than a non-owner occupied. So people would go out and they would get financing for a new primary residence that they're living in, or they'd refinance a property as a primary residence that's really a rental so that they could get the better interest rate. So investors deployed the mortgage maintenance. Now, again, I didn't know that was still happening. I don't know that it is. but it's certainly a real risk that you would take if you're knowingly going into something like that, right? And let's take it all the way to its conclusion. What happens if you get caught doing that? So they're not going to, put you in handcuffs or levy bank accounts or anything, but they are going to call the note due. And what that means is that you're going to be forced to refinance that mortgage at your expense within, I don't know, 30 or 45 days or 60 days, whatever timeline they deem is acceptable. So that would be the worst case scenario of something like that. Anyway, I went off on a tangent.
It really happens, and I can speak to it because I'm more on the technology side for those that are on the call. And there is a ton of technology that provides for ownership and occupancy surveillance through the servicing companies that's being deployed now. And it's really all about, if something were to happen, it removes your ability to give yourself the remedies, right? So if the lender or servicer can say that you intentionally did something against the terms of your note, Caeli, it removes your ability as a borrower to try to negotiate your way through the problem, I imagine.
So just out of curiosity, since we're talking about this, under what circumstances would it be viable? Like I said, it says intend, and if, God forbid, something happened where you were physically forced to move, and that now was either a rental or became vacant or whatever, what kind of burden of proof would be on the individual to
You have to spell it out in a handwritten letter that you intentionally committed fraud. I think that's pretty much it.
All right. What else? Anybody else?
We did have one question going back to the all-in-one, going to an all-in-one loan, and with regards to escrows. So you mentioned this earlier in the call, Caeli, but when it comes to your escrow accounts for your insurance and taxes, et cetera, do you actually, when you calculate your monthly savings, do you use those escrows in the math or not? When you try to calculate, does the refinance make sense?
No, the escrows, the tax and insurance shouldn't play a role at all, because those numbers are going to be those numbers. No matter what happens with the refinance, those are not going to change. The taxes aren't going to go up because you refinance. That's only upon a sale, right? That's the only time property taxes are going to change, at least as far as I know. Maybe there's some counties out there that I'm forgetting or not thinking about, but I don't believe so. And it shouldn't change your insurance policy. Now, those things are going to change themselves over time as values of homes go up and things. But when you're calculating the net tangible benefit of the refinance, whether it's a rate and term or a cash out for the reasons that we've described, no need to put in the tax and insurance. In fact, take them out. They have no bearing whatsoever on the conversation.
Thank you very much, Caeli. Last call for questions, and I will, I'm going to speak about those folks out there that try to convince you to refinance. Caeli, I don't know if you ever heard stories about this, but I've heard stories where the person trying to have it make sense uses old tax data or rounds down on insurance policies to try to make the new payment make sense, only to find out that at the end of the day, the payment actually doesn't make sense because they tried to include wrong numbers for taxes and insurance.
Gross. Well, yeah, that's horrific. Obviously, it would never happen here. It's our job is to educate you guys. Yes, obviously we get paid for doing your loans, but we are so not interested in some one-off commission. The relationship, and I hope that translates to you guys. The relationship is really what is important to us, and being able to have opportunities to earn your future business. We know that's not a foregone conclusion. It's unfortunate that there's people like that will for a few bucks would take advantage of a situation and try to trick somebody into refinancing when it did not make sense for them. We'll be the first ones to step up and say, Mr. Smith, Mrs. Jones, I don't think refinancing right now is to your advantage.
It looks like one last question from Eddie is, can you speak on the difference of point between interest only rate and 30-year fix? So I guess the question is range of rates given the optimal scenario, Caeli, where would you be?
Yeah, let's take a look. So I'm going to cheat. So interest only, you guys, the calculation is so easy. It's not going to be to the penny, but it's going to be damn close. So if everybody wants to take out their iPhone or get their calculator out, I'm gonna say that interest, take $100,000, okay? And put in times 8 and then the percent sign. And then I want you to divide that number, $8,000 by 12. Your interest only payment within a few bucks is going to be 666. I didn't do that on purpose, I swear, is going to be $666 a month, interest only. That's at 8%. So what I'm going to do then here is I'm going to go 100,000 amortized over 30 years and just kind of see what happens at the different rate levels, right? And try to help us figure that out. So a 6% interest rate on $100,000 principal and interest 30-year fixed is $599. So maybe it's a 1%. Let's try 7. 665. So it looks like a 1% differential. You're going to need the, am I doing this right? The interest only payment. Let me try one more thing. Hold on, guys. Yeah, the interest rate between the fixed and the interest only, I'm thinking about 0.5 point. Makes sense in terms of considering one over the other. So if I got a 8% interest only, 666 at 7.5 principal and interest, 699. So there may be some slight advantage to looking at the higher interest only loan. Is that what you were asking, Eddie? Did I answer that?
I'm going to believe that you did.
Okay.
There's no notes in there. I did want to repeat. One of the guests had asked if we could repeat the answer to the all-in-one question, and the answer to the all-in-one question was, oh, Eddie says yes. Caeli, you nailed it.
Okay.
So Eddie's cool. Thank you, Eddie. So going back to the all-in-one question again, when you're looking at any type of loan, Caeli, I think you made it clear, don't ever look at the taxes and the insurance in that evaluation. So that
Correct. And I thought I saw a question come over too, is can the all-in-one impound? Can we escrow in an all-in-one? The answer is no. You have to, if anyone is interested in getting an all-in-one mortgage, you will be responsible to cover the taxes and insurance annually or semi-annually whenever they're due on your own. The servicer, which is a FDIC insured bank, it's either North Point or Merchants, I think, that end up servicing these loans, they will not be responsible to collect and then pay on your behalf taxes or insurance.
It looks like we have one more question before we call it here. And the question is, is the length of the loan different for an interest only? In other words, is it a straight term, or is there a certain period of time that's interest only with a fully amortized payment?
So I would say it's going to depend. More often than not, at least when they were more prolific, you would have 10 years interest only, and then it would revert into a 30-year amortized payment, so as not to have too much of a shock. It's not going to be, it's very rare that you're going to find 10-year interest only, and then for the following 20 years, 240 months for whatever the balance is. They used to do that back, I don't know, 20 years ago. For now, I believe the product that we're going to see for interest only will be 10 years interest only, and then the rate will be amortized over 30 years and the principal and interest payments. So it's really a 40-year mortgage, if that makes sense. So 10 years interest only, followed by a 30-year fixed. So 40 years would be the ultimate span or term of that loan. Keeping in mind, you guys, while it's important to know the answer to that, the percentage, if you haven't heard me say this, the percentage of people that start with a 30-year fixed and make 360 payments later to pay it off is less than 1%.
We want to find that person, right, Caeli? Who is
Yes,
that person?
I want who, where are you? You're somewhere in the United States, and you were born in 1894.
That's pretty old. That's pretty old. Awesome. Well, today has been a phenomenal source of information. If you do have any questions after today, we'll get this posted up in the community here in about 24 hours. Certainly, always give a phone call to Ridge Lending if you want to talk about anything you heard on this recording, or ask Caeli to figure out her $666 a month payment again, which she said she didn't do on purpose, but I don't know if I believe her. In any event, it's 855-74-RIDGE. You can always email the Ridge Lending Group team at info@ridgelendinggroup.com. And of course, you can always come here every Tuesday and check us out what we're doing live. So thank you very much, everybody, for coming. Caeli, thank you as always.
Peace, people. Thanks for being here. See you guys next week.
Bye.